Hello and welcome to this recording. This recording is a part of the course Portfolio and Equity Analysis, and we are going to cover chapter 1 here. So this is just the beginning of the course. We are going to discuss here a brief history of risk and return. So we are going to start with what do you understand by returns, what do you understand by risk. Then we are going to discuss how do you measure returns, how do you measure risk, and how do you combine both. So how do you see the totality of aspects, how do you combine risk and return and see them together. Okay, this recording you can use in for getting help with your undergrad studies or your grad studies wherever you come across risk and return as a topic, or even you can use it for professional certifications like CSC, CFA, FRM, or even like a certification like CFP. So let's start with it. So we'll start with the YouTube video. So just a bit of patience, I'm just loading that video. I'll be playing it also.
They say buy low, but if you were buying Apple stock in 1998, you were buying really low, under $1 a share in today's terms. When you first invested in Apple, how much money was your initial investment?
We started on the 1998, 70,000 for the 600. That's how we started. We didn't spend much money on it. That was cheap.
This is before the iPhone, even before the iPod. That was actually a low point for the Apple companies. What made you so excited about Apple?
I think it's 1998 or 1999. I went to the Mac World Conference and I saw Steve Jobs talking, and that, the whole thing triggered it. It's not just about the product, and they kind of start to be interested in their business.
Neen Wang and his wife Ting Chen didn't stop buying Apple stock in 1998. They say they've invested tens of thousands in the company over the years, an investment in a stock that's up over 13,000% since they first bought. Just recently, you finally hit $1 million in your total investment. What was that moment like?
She's more excited about we are participating, not the money.
Yeah, not the money part.
Neen and Ting have sold some of their stock to buy things like a vacation home, but they say they've always held on to most of it. When you guys have sold stock, was it because you didn't have confidence in the products or the business?
Never. Always discipline. Discipline. The market goes up and down. You cannot catch it.
Now Apple Watch has come out. A lot of analysts have said they don't think Apple Watch sales have been nearly as high as expected. So is this a time for you to stop and assess and decide whether you want to cash in on some of the stock? What are you guys going to do?
Any new first generation comes out, maybe there's a waiting time. Yes, of course.
So what does the couple think about the stock today?
I think it's time to buy.
Time to buy?
Yes.
More? That's news to him.
So this is an example of a common person making an intelligent investment. So they invested in Apple, so under $1 in 1998. So let us check out Apple's price today. Stock price. So it is $178. So they have of course made a gain. So they invested at, let's say, around $1 in Apple, and today in 1998 and today in 2018 the stock price is around $178. So it has appreciated. Okay, so what do we learn from this video? First, there is substantial reward for taking risk. Now they have invested their money in stocks. They did not invest in a bank deposit, or let's say in an insurance investment product, or let's say in any other product, right, that is giving a fixed income. So they invested in stocks. So by going into stock market, they undertook volatility, they undertook risk, and in investment terms, if you take additional risk, you get additional rewards. So for intelligently bearing risk, market always rewards. Second, higher the risk the investment has, higher would be the expected returns that you can expect from the investment. So these are the two learnings that we get by looking at a common person who had invested in Apple stock, taken on risk and got substantial rewards. So what do we mean by returns? So there are different ways to look at returns: dollar return, total return, average return, geometric mean, money weighted returns, or let's say effective annual rate. So let us take an example and understand these different concepts, how to calculate them, what kind of questions can you get in your studies, and all those things. So we'll continue with that couples in example. So I'm just opening an Excel sheet. Now what did the couple do? In 1998, they invested $1 in Apple stock. Okay. And in 2018, so how many years have passed? So 2018 minus 1998, 20 years have passed. And the stock is trading at $178 per share. So it has appreciated substantially. So the couple has got returns. Then how do you look at returns? So there are different ways. One is dollar return. One way to look at it is dollar returns. Now dollar returns measure how much return have you got in hard dollar terms. So for in this case, the couple has, if the couple sells the stock right now, one stock, they would be getting $178. And how much did they invest to get that $178? They invested $1. So the formula for dollar returns is final value minus initial value. So it will be 178 minus 1. So it is $177. Now the issue with dollar returns is there are two issues. It cannot be compared. It cannot be used for comparisons. Assume there is an investment like this in which you invest $1 and you get $178. So dollar returns are 177. There is another investment in which you invest $2001 and you get $2178. So your dollar returns are still 177. But which investment is better for you? So answer would be the investment A, because $1 has grown to a massive amount of $178. In second case, 2000 has gone from 2000 to 2178. So dollar return doesn't measure two things. It doesn't measure, it cannot be used for comparisons because it is not in percentage. Second, it doesn't have any time element in it. So this you got in 10 years, this you got in 20 years. You don't know it from dollar returns. So there are these limitations that dollar returns have. So to counter these limitations, we can use total returns. Total returns is in percentage terms. So formula for that will be final value divided by initial value minus 1. One way to do it. Second way, final value, I'll open the brackets, final value minus initial value divided by initial value. So calculating it in both ways, 178 divided by 1, final value is 178, initial value is 1 minus 1. So 17,700% is the return. Here if you calculate by this way, final value 178, initial value 1 divided by initial value 1. So percentage sum 17,700%. Okay. Now total return also has one limitation. It doesn't have any time involved in it. So to consider time into it, we can look at average returns. Average returns are nothing but total returns divided by number of years. So total returns divided by number of years. So if you calculate that, it will be 1700% divided by how many years? 20 years. Okay. So it will be 885% returns per year. But there is a limitation to average return also. The limitation is it doesn't consider compounding. So what happens when you consider average returns? So it assumes simple interest. It doesn't assume compound interest. It means you're not going to get any return on the return already generated. So it is like doing this. You invest $1 in Apple stock in 1998, it goes to $2. So $1 is your gain. You remove that $1 and keep it in your account, and again start your investment with $1. Now is the couple doing that? Couple is not doing that. They have not withdrawn money from 1998 to 2018, let's say. So they are not doing this investing, withdrawing, whatever gains that they are getting, they're withdrawing. So their gains are reinvested into Apple stock. So that is the concept of compounding. So to consider compounding, we generally use geometric mean. Now formula for calculating geometric mean is final value divided by initial value to the power 1 by n, where n is number of periods, minus 1. So if you put it in formula, it will be 178 divided by 1. Final value is 178. The initial invested value is $1 to the power 1 divided by 20 minus 1. So each year Apple stock has given you 30% return. Now this is the most commonly and logical way to look at returns. So geometric mean, also known as CAGR, compounded annual growth rate, CAGR, is the most commonly used way to look at returns. How do you calculate it? Final value divided by initial value to the power 1 by n minus 1, or you can use a rate function that is there in the Excel. So equal to rate, open the dialog box. Sorry, there was a typo there. So rate, open the dialog box. So n per, that is periods, 20. PMT is regular investments or withdrawal, nothing. Initial value $1. Signs are important. So everything that is invested is negative. Whatever you get is positive. So 178 is the final value. So what happened there? Guess, so you should put a positive number here. That was the reason. So 30%, easier way is final value divided by initial value to the power 1 by n minus 1. Okay, so this is one way of doing it when initial value and final value is given. Sometime instead of giving initial value and final value, in exams you get something like this. So they give you yearly returns. Okay, so let's say there is a 5-period horizon, 1, 2, 3, 4 and 5, and yearly returns are 9%, 3%, negative 2%, you lost money in the third year, then 5%, and let's say 11%. So they may give you this in the exam and ask you average returns or geometric returns. Now how do you calculate that? Average returns is addition of all these returns divided by n. So addition of returns, sum, it's simple arithmetic average. So addition of all these returns, so 9% plus 3% minus 2%, 5%, 11%, add everything and divided by n. N is 5 years. So average returns in this case is 5.2%. Right? Now to calculate geometric mean, we use this formula. So formula is 1 plus first year's return multiplied by 1 plus second year's return, right, multiplied by 1 plus nth year return. So this is step 1. Step 1 of calculating geometric mean is multiplying each year's return. So what do you do here? What are you doing here? You are saying that you invested $1 and you're growing that $1 till the nth period. So in this case, you invested $1, it got you 9%, then 3%, then it decreased by 2%, then 5% and 1%. So you are calculating what would be value of $1 invested in the beginning at the end of 5 years. Okay, so this is step 1. Step 2, you calculate a geometric average of it. So how do you calculate geometric average? So it will be step 1 to the power 1 by n minus 1. So if we put this thing in application, it will be 1 plus 9% first year's return multiplied by 1 plus 3% second year's return multiplied by 1 plus 1 minus actually 2% multiplied by 1 plus 5% multiplied by 1 plus 11%. So you have grown your money by these percentage. So $1 at the end of 5 years becomes $1.28. So how much return have you got? Step 1 to the power 1 by 5, because n is 5 years minus 1 minus 8 typos minus 1. So how much return have you got? 5%, 5.10%. Now please note certain things. First thing, if you see arithmetic returns here and geometric returns here, as well as arithmetic returns here and geometric returns here, you can notice one thing. Geometric returns are always lower than arithmetic returns. An MCQ question for you. Geometric returns are always lower than arithmetic returns. First point, as the time period increases, the compounding has more impact. So geometric return and arithmetic return will have divergence. The difference between geometric return and arithmetic return will increase as the time increases. Okay. Now there is a limitation to geometric returns also. It cannot be used when there are multiple withdrawals as well as investment into the account. For example, let's say the couple invested in Apple stock, but they did something like this. So it's a 5-year investment in Apple. They started with $1, right? Then in the second year they didn't invest anything. They again reinvested $2 into the Apple stock, and at the end of 5th year they got $30 back. So they invested $1, then they again reinvested $2 at the end of 3rd year, and then they got $30 back. Now you cannot use average or geometric means here because it doesn't have relevance. Both of them are time weighted, so they have weighting according to time. But here there is money that is reinvested, as well as means it can be reinvested or it can be withdrawn also. So for example, if Apple gives dividends and you invest only one time, so you invested let's say $100 here, it gave $2 dividend each year, and you sold that stock for $1,000. Now in both the cases there are withdrawals as well as reinvestments. So here you are doing reinvestments, here you are getting withdrawals in form of dividends. So in these cases you cannot use geometric mean. So if you want to find yearly returns, then what this stock has given as well as this stock has given, or any investment has given, you need to find money weighted return. Now money weighted return, also known as IRR, is calculated mathematically by equating NPV of the investment, net present value of the investment, to 0. Once we discuss time value of money, we would be discussing that. But for the time being, to calculate yearly return, we can use the IRR function. So use IRR, open the bracket, select all these investments, press enter, equals to IRR, open the bracket, select all these cash flows and do enter. So investment A has given 114% return, investment B has given 79% return. Okay. The last part, that is effective return. Effective return arises when you have invested for less than a year and you want to convert it to a yearly return. Let's say you are investing in a quarterly investment that is for 3 months and you have got 3% return in 3 months. So you want to find out how much return you would have got if you would have continued that investment for the entire year instead of a quarter, that is for 3 months. So you can simply find yearly returns by using a logic that if you're getting 3% in 3 months, then how much you would get in 12 months. So it will be simple. So there are 4 3 months period in a year, or there are 4 quarters in a year. So 4 multiplied by 3%. So you would have got 12%, but this would be the wrong answer because it doesn't assume compounding. So to consider compounding, we can use EAR, effective annual rate. The formula for that is 1 plus period rate, period less than a year, to the power number of periods in the year divided the period for which you have invested. So it looks complicated, it's very simple. So you are getting 3%, so equals to 1 plus 3%. I'll write it down, right, to the power number of periods in a year. So we are considering 3 months period. So how many periods are there in a year? So there are 4 3 months period in a year. So you can say 4, or you can say 12 months in a year divided by, you have got returns for 3 months, that is 4. Okay, and since we are adding 1, we have to subtract 1. So you are getting 12.55% return. Now please focus, it is higher than the yearly multiplication that we did because we are assuming compounding, and the formula has -1 here. So effective annual rate will be higher than the nominal rate by just multiplying it because of impact of compounding. So we have seen dollar returns, the dollar rate that you get, dollar amount that you get, total returns, percentage returns that you get, average returns, it is nothing but how much yearly returns have you made considering simple interest, not the compounding thing. Geometric return considers compounding, considers time, has a limitations that it will not consider inflows and outflows of money. Money weighted return considers inflows and outflows of money, calculated by trial and error, used means also known as IRR, internal rate of return. And effective annual rate we generally find out when the period of investment is less than a year and we convert it to a yearly thing. So in exam, in your courses, you can be asked these things, so be comfortable in calculating these things. Okay, now next is range, risk. So we have considered how to look at returns. You can look at dollar, total, average, geometric, or money weighted, or EAR, right? These are different ways of looking at return. How do you look at risk? Now what is risk? Now mathematically, risk is measured as deviations from the expected value. Expected value in most of the cases is the historic mean. So when we consider risk, we consider deviations from the historic mean that the investment is showing. Now this deviations can be in positive direction also, and it can be in negative direction also. So we are considering negative returns that the stock has given as well as positive returns that the stock has given that are different from the expected, at the average return that the stock is expected to give. Okay, now there are different ways to look at risk. Like we have seen, there are different ways to look at returns. The easiest way is range. What is range? Range is highest value and the lowest value that the stock has shown. So let's say Apple stock has given a lowest return in a year of 30% and a highest return in a year of 141%. So range in this case will be negative 30% to 141%. Now logically, higher range that the stock has, higher would be risk of investing in it. So if a stock has same average returns, but stock, let's say, take an example, stock A has average return of 5%, stock B also has an average return of 5%. Okay, but stock A has a wider range, minus 10% to 25%. B has a smaller range, so 2% to 11%. Then which stock has lower risk? So B has lower risk because it has smaller range. So smaller the range, smaller will be risk. But it is not a very common way to look at things. We generally look at variation, variance and standard deviation. So these are mathematical terms. So let us take this example and I'll help you to decipher what is variance and what is standard deviations. Okay, so first I'll tell you what are the steps to calculate variance, what are the steps to calculate standard deviation, then we'll look at the interpretation of it. So when you're calculating variance, step 1 is find out the average return. Now what is the average return that the stock has given? So addition of all these returns divided by n, that is 5, or a simple average function in Excel. Okay, so the average return that the stock has given is around 5.2%. What are we interested in? We are not interested in average. We are interested in deviations from average. So we are going to calculate deviations that the stock has shown each year. So second step is deviations each year. And mind you, this is an intermediate step. This is not the variance or standard deviation. So deviations per year. So stock should have given 5.2%, but it gave 9%. Okay, so yearly return minus the average return. Okay, same way, yearly return minus the average return, yearly return minus the average return, yearly return minus the average return, and yearly return minus average return. So you have calculated deviations. Now for us, risk is both the negative deviations as well as positive deviations. We are not bothered about sign. Okay, so we need to remove impact of sign. So we are not bothered that these deviations are negative. We just want to consider deviations. We are not bothered about whether they are negative or whether they are positive. So how do you remove the impact of signs? So you take a square. So square removes the impact of signs. So we'll square it up. So this to the power 2 removes the impact of signs. Okay. Now the first thing, step 3 will be calculating average deviations. What is average deviations? Average deviations will be sum of these squared deviations divided by 5. Okay, so this is average squared deviations, not average, average squared deviations. This is called as variance. So what is variance? Mathematically, variance is the average squared deviations that the stock has. Okay, now there are two ways to look at variance, two ways to calculate variance actually. If you're looking at population sample or population size, then you divide it by n, like in our case. But if you're looking at sample, then you divide it by n minus 1. But for simplicity, right now we'll divide it by n. So your variance is average squared standard deviation that the stock has shown. But since it's a square, it doesn't have any meaning. Okay, so variance is not widely used. So we deduce it further to step 4 and we calculate standard deviation. standard deviation is square root of variance. Standard deviation is square root of variance. Okay, now this has meaning for us. Now if you seen normal curve, okay, so we'll see what is a normal curve. Now what is a normal curve? Normal curve is generally mean and deviations from the mean, the probability distribution of samples around mean. Okay, so there is maximum probability of distributions that are near mean. There are very less probability of distribution being in the outliers. Okay, what does it mean for us for investments? So let's say this stock is giving you average return of 5.20%. Then based on the historical average, you can say that first 66% or 68% of observations, near about that 68% of observations will lie in the difference of one standard deviation. So if you're expecting, if you are investing here and you want to see what would be expected return next year, so 68% of times it will be within one standard deviation range, that is average minus standard deviation to average plus one standard deviation. Okay, so you can expect 68% of times if you're investing here, you can have a return of 0.62 to 9.78 based on historical average. Next, 95% of time you can expect two standard deviation range. So returns will be this minus 2 multiplied by standard deviation, this plus 2 multiplied by standard deviation. Okay, so if you are investing and in the stock, you can expect 95% of the times your returns will range from -4 to +14. Third, you can expect 99% of the time the distributions will be mean minus 3 into standard deviations or mean plus 3 into standard deviations. Okay, so what does standard deviation signify? It signifies probabilities. 68% of time you will have a range of one standard deviation. So in this case you may get 68% of times 0.62 to 9.78% return, 95% of time these returns, and 99% of times these returns. So that is the reason standard deviation is the most commonly used risk term in finance. Okay, so we have seen range, variance, and standard deviation. Now we know that standard deviation is the widely used term in finance. Now the relationship between risk and return, it's very logical. If higher risk is there, higher returns would be there. So example, if you're looking at different investment classes and their returns, so we are looking at small cap, large cap, long-term bonds, treasury bills, and comparing it with inflation. So over a period, highest return has been achieved by small cap stock, then by large cap, then by long-term bonds, and then by treasury bills, because highest risk is there in small cap, highest risk, then the risk is followed by large cap, then bonds, and then by bills. Bills are the least riskiest thing. Okay, so higher the risk that you take, higher would be the expected return. Now important asterisk here, or important footnote here, for this relationship to hold, the period should be large. So it may happen that you invest in small cap and you say that, let's say I was saying that it should have higher returns, so I invested in small cap, but the returns are negative. It may happen. So given a large amount of time and based on historical things, higher risk would entail higher returns. Okay, so they are just giving you a perspective of large cap stocks. So over the period, large cap has been largely positive except the periods when there was troubles in the economy. So world wars, then dot-com bubble burst, then the recession, that financial recession that we had in 2007 2008. So all these periods when there is uncertainty in the market, large caps generally don't give returns. Same thing with small cap. So world wars, then different wars, then dot-com bubble burst, not much impact on small cap. So, and the financial recession. Bonds also exhibit the same relation. Treasury bills almost have always positive returns. Inflation, there were periods of negative inflation in past, not very relevant to the discussion. We have seen how to calculate variance, so you can either use this formula or the steps that I have given. Steps are easier, so always remember those steps. You can watch this video again and note down the steps. So we have seen normal distribution and the probability. So this was showing normal distribution of the returns of large cap stock, distribution according to probability model. Okay, so just a quick recap. We have seen what returns mean. We have seen what risk means. We have seen dollar returns, actual dollars that you make, total return, percentage return, helps in comparison, doesn't have time. Average return has time, doesn't have compounding. Geometric returns has compounding but doesn't consider inflow and outflow of money. IRR considers inflow and outflow of money, also called as money weighted return. Then we saw risk, range, standard deviation, variance, most commonly used term were standard deviation. Then we saw peculiar characteristics. Higher the risk expected, higher would be return expected. So this is about it for the first class. We'll catch up in the next recording in the next class. So do a lot of problems based on this, right? You can find a lot of problems on the net, but any problem you can just look at this video and try to solve them. And if you have any difficulties, do get back to us. Okay, so thank you for your time. We'll catch up in the next class.